Welcome back to Counting the Cost, your weekly business stop here on Al Jazeera. Before we carry on with our look back at 2009, just want to pause and bring you a bit of news from Dubai, the major debt crisis there, which we've been following so closely. Big news, of course, was the bailout. Abu Dhabi stumped up $10 billion to get Dubai World over the first major hurdle. That was the Islamic bond, or Sukuk, which matured on Monday, 14 December. 4.1 billion goes towards that, which leaves a little under 6 billion for interest repayments and working capital through to the end of April 2010. Here's the catch, though. That 10 billion's been issued in bonds with interest to be paid. So in many ways, Dubai World hasn't moved on, just dodged the first bullet. For its part, the Dubai government said this on the day of the bailout, quote, "Today's actions taken together demonstrate our strong commitment as a global financial leader to transparency, good governance and market principles. Dubai is and will continue to be a strong and vibrant global financial centre. Our best days are yet to come." So the default on the Islamic bond was avoided, and just as well too. Have a listen to this from Sunny Bhatia. He's an economist from Global Investment House in Kuwait, which did default and learnt the hard way how unforgiving the market can be.
It has been a very challenging time, and the defaults are not just new to global, but they are also new to the region. So the initial reaction of the creditors was anger, frustration, an element of lack of faith between global as a borrower and they as lenders, some kind of anger even at the regulators and the state of Kuwait. But as we move forward, the first thing was, as a result of our transparency, we were in a position to move from a stage of a complete distrust, anger and frustration to partners who are willing to look at each other's situation and come to an amicable solution.
Now back to this year in review and a roundtable economic discussion hosted by our own Summer El-Shahat. She was joined in our London Broadcast Centre by William Buter from the London School of Economics and Anne Pettifor from the New Economics Foundation.
Governments have to somehow substitute for that collapse and that failure, that collapse of output. And in doing so, they're going to include their total debts. They're going to expand on their total debt and increase their deficits. But when you compare what's happening in the UK, for example, now, where debt is as a share of GDP, total debt as a share of GDP is due to rise to 70% of GDP. In 1946, at the end of the Second World War, it was close on 300% of GDP, and governments started to spend, and economic recovery came about. You know, with time, and the debt reduced, the deficit fell. So until we have economic recovery, we can't expect deficits actually to come down.
Well,
but do you agree with that?
I think the parallels with wartime debts are highly misleading. The fact that they were wartime debts incurred as a result of a national war against a hated external enemy makes it very different in terms of the willingness of the people to put up with burden sharing, etc., from a debt that is incurred as a result of a civil war, right? A screw-up, the grotesque mismanagement across the board of the financial system and indeed of the regulatory system and of supervisory policies. So I think that we are in a much more serious situation than the level of the debt would indicate. We have not seen debt rising to this level during peacetime periods. During peacetime periods, we've only seen debt levels like this on the way down from a war. So this is quite unique. And of course, the flow deficit. Britain has a structural, now a cyclically corrected deficit of well over 8%. Right, primary deficit, even the non-interest deficit. So we have to basically therefore cut spending or raise taxes by 8% of GDP in order to restore solvency.
But the problem here, I suppose, is that there's now an incredible disconnect between what's going on in the financial markets and what's going on in Main Street in our world. And we have incredibly high unemployment rates. And many people would say, if anything, we need more of a fiscal boost.
Absolutely. I mean, I'm not as fearful of the level of debt and deficits in the rich countries, and that's because we do need to substitute for this collapse of private sector output. We've heard today from the Chancellor that British GDP has fallen by something like 4.7%. That's enormous. You know, those are huge sums of money. £50 billion has been taken out of the economy. And that has to be substituted for, or else the thing gets worse.
Do you think if the rescue plans were more effective, then right now Main Street would not be suffering as much?
Well, clearly the rescue plans have stabilized the banks, but not brought them to the point that they can engage, are willing to engage, or even able to engage in normal financial intermediation between households and non-financial businesses. So no, in that sense, we've rescued the system, but into a state of limbo. We still have zombie banks by and large. We see credit to the non-financial private sector actually declining in Europe, in the UK, and only growing very slowly in the US. So I think in that sense, the rescue has been a qualified failure, yes.
It does seem as if banks do have money to be investing in commodities and in the stock markets. You know, that money is being challenged into certain markets and creating bubbles there. So while we're not having credit flowing to the productive sector of the economy, there are bubbles being inflated, and indeed Nouriel Roubini has called it a monster bubble.
Do you then think that a stock market bubble is likely?
Well, we don't have one yet. At least not in this part of the world. I think the main effect on asset markets of the massive injection of liquidity we've had all through the West and we're still having will be in emerging markets that are trying to keep their exchange rates from appreciating against the dollar and other currencies, and in doing so basically import the liquidity and create massive domestic credit and asset booms and bubbles. So I think the next big asset boom and bust and credit boom and bust is likely to come from emerging markets.
Many people now are saying that we have got a recovery. From what you're saying, it doesn't sound as if this recovery is sustainable in any which way.
I mean, I think that's because the debt bubble hasn't worked itself through yet, that people don't understand that this is a debt deflationary crisis and that they're analysing it incorrectly and therefore not seeing the end of it. So no, I think it's quite a long way. I mean, the talk about green shoots in March and what I regard as a stock market bubble and a commodity prices bubble, was all cheering everyone on. But we get less and less talk now of green shoots. And no, I think it's pretty gloomy out there.
But there were green shoots for the banking sector. I mean, it's still looking pretty rosy for the banks, no?
No. They are, they're treading water. And have not yet restored their capital or the liquidity levels to the point that they can function as they ought to, providing credit to the real economy. I think the green shoots are there in the sense that output has stopped declining almost everywhere, possibly even in the UK now. But it is miserly growth, and we're going to see rising unemployment in much of the West for at least another year. And the risks of a further downturn is non-negligible. If the banking system stalls further, as I think it well may, especially in continental Europe, then I think we could have a serious risk of a further slowdown.
What worries me is that the total consensus now is for restricting that fiscal stimulus across the board. And that is very frightening. That happened in the 1930s. In 1937, when Roosevelt decided that he was going to cut spending, 36, and the economy in the US nosedived and unemployment rose dramatically and the stock market had the biggest fall it had had since 29. And only then did they wake up again and re-inject a fiscal stimulus. So my fear is that the political consensus for cutting spending is going to exacerbate this current crisis.
Any level of debt is sustainable, and therefore any fiscal stimulus is sustainable as long as there is the credibility that in the medium and long term the debt will be serviced properly. That credibility is not present in many countries. It may be in Britain because Britain has this, ram it through easy political system. But in countries like America, there's fiscal paralysis. In Greece we have this, and there are many countries which therefore can simply not afford to continue fiscal stimulation because the markets will take fright and there will be a combined sovereign debt crisis and exchange rate crisis.
Looking forward to 2010, what are your predictions?
Emerging markets will continue to do well, by and large, with notable exceptions in and around Dubai and parts of Central and Eastern Europe, although there's some recovery even there. I think the advanced industrial countries, unless we see some imaginative attempts to equitize the debt, right, and sort of recapitalize not only banks, but households and governments through intelligent forms of financial engineering, as opposed to the destructive ones we've seen, I think this could be a slow year in the advanced industrial countries.
I think there is a massive rearguard action now on behalf of the banks and the finance sector to argue that actually the problem is with government spending and not with the finance sector. And so the focus is going to be shifted away from the banks and onto government spending. And I think people are going to be badly hurt by that. And I fear that that is going to lead to political instability and volatility, and I fear that very much, particularly in Europe. Unless the concerns of the citizens are addressed and the focus, they're not blamed for the crisis, which is what's happening now, we will get a political backlash.
We need to get rid of the debt, and the only way to do that quickly is to turn it into equity.
Thank you both for joining me.
And that is just about it for this week. Time enough, though, to run you through our online business content at the Al Jazeera English website. Here's the main business page, up-to-date headlines and video on demand on all the latest business news there. This is the Counting the Cost page. You'll find it by clicking on the programs link. My weekly blog is up there, plus this week's and previous week's episodes to catch up on. And on the blogs page at blogs.aljazeera.net, there are regular contributions to the business blog from our correspondents and editors right around the world. It is all, as ever, at aljazeera.net/English. And that is it for Counting the Cost, not just for this week, but for 2009. We're taking a bit of a break over the Christmas and New Year period. I'd like to thank you for joining us in our first year on air, and we'll be back bigger and better in 2010 from the middle of January. I'm Kamal Santamaria from the whole team. Thanks for joining us. We'll see you next year.